In this video we will discuss cost of goods sold.
What is cost of goods sold?
Cost of goods sold, also referred as cost of sales, measures the direct cost incurred in the production of any goods or services. It includes material cost, direct labor cost, and direct factory overheads, and is directly proportional to revenue. As revenue increases, more resources are required to produce the goods or service. Cost of goods sold is often the second line item appearing on the income statement, coming right after sales revenue. Cost of goods sold is deducted from revenue to find gross profit. Cost of goods sold consists of all the costs associated with producing the goods or providing the services offered by the company. For goods, these costs may include the variable costs involved in manufacturing products, such as raw materials and labor. They may also include fixed costs, such as factory overhead, storage costs, and depending on the relevant accounting policies, sometimes depreciation expense. Cost of goods sold does not include general selling expenses, such as management salaries and advertising expenses. These costs will fall below the gross profit line under the selling, general and administrative (SG&A) expense section. The basic purpose of finding cost of goods sold is to calculate the true cost of merchandise sold in the period. It doesn't reflect the cost of goods that are purchased in the period and not being sold or just kept in inventory. It helps management and investors monitor the performance of the business. Cost of goods sold formula. Cost of goods sold equals beginning inventory plus purchases during the period minus ending inventory. Accounting for cost of goods sold. IFRS and US GAAP allow different policies for accounting for inventory and cost of goods sold. Very briefly, there are four main valuation methods for inventory and cost of goods sold. 1. First in first out, FIFO. 2. Last in first out, LIFO. 3. Weighted average. 4. Specific identification. A little about specific identification. SI is special in that this is only used by organizations with specifically identifiable inventory. Costs can be directly attributed and are specifically assigned to the specific unit sold. This type of cost of goods sold accounting may apply to car manufacturers, real estate developers, and others. In simple words, cost of goods sold is the direct cost of producing a good, which includes the cost of the materials and labor used to create the good. COGS directly impacts a company's profits as COGS is subtracted from revenue. Companies must manage their COGS to ensure higher profits. If a company can reduce its COGS through better deals with suppliers or through more efficiency in the production process, it can be more profitable. Summary of today's topic. 1. Cost of goods sold includes all of the costs and expenses directly related to the production of goods. 2. Cost of goods sold excludes indirect costs such as overhead and sales and marketing. 3. Cost of goods sold is deducted from revenues, sales, in order to calculate gross profit and gross margin. Higher cost of goods sold results in lower margins. 4. The value of cost of goods sold will change depending on the accounting standards used in the calculation. 5. Cost of goods sold differs from operating expenses, OPEX, in that OPEX includes expenditures that are not directly tied to the production of goods or services.